Good morning, everybody. We are here on Friday. We're off. The market is off and running, and we have plenty to talk about as always. So I'm excited to be here, excited to see those of you who are here so far. Maybe we'll get a few more people coming in as we get things rolling. We'll see how that goes. But let's go ahead and dive in. This is my weekly live stream for Rebel Income, and if you are not familiar with what Rebel Income is built around, this is a strategy that is designed to generate income on a practical basis, on at least a monthly basis, using the stock market and specifically using options. We work on the selling side of the options market rather than being a traditional buyer. We're sellers. That means that instead of good morning, Gib, and one quick note for you, Gib, I don't have an excuse, so I just simply need to apologize to you. I know you have been waiting for a response from me, and that was planned. I was planning to do that last weekend, and the weekend got away from me, and I apologize. So I will make that a priority. If not today, tomorrow. So thank you for your patience. But in any event, being an option seller means that we're really kind of taking the opposite view of people who are traditionally just buying options. If you buy a call because you think the stock is going to go up, or you buy a put because you think the stock is going to go down, we're taking a little bit different view. If we think the stock is going to go up or stay about where it is, we think the stock is available at an attractive discount. And the fundamentals of the company are really solid, and that's a stock that becomes a stock that is a good candidate for a put selling trade, for an income generating trade. We use put selling as an opportunity not only to generate that income, but also to take a page from the book of a lot of value investors like Warren Buffett, who find ways to set their own price that they're willing to buy a stock at and generate income in the meantime. And so that's really kind of the nuts and bolts. Well, excuse me, that's really kind of the gist of what Rebel Income is designed to do. The nuts and bolts are in the finer details, and those are some of the things that we're going to be spending today talking about. And we do that by looking at the actual trades that we're following and tracking right now in the market. I like to do this live on Friday for a couple of reasons. Live, number one, because we want to compare the positions that we're watching, that we're holding. We want to be able to think about those and talk about them in real practical terms. As the market is moving, those prices, the movement of those stocks' prices have an impact on the positions that we're working with. And so we want to be able to talk about that in the moment and try to see how that may impact decision making or what your strategy is. So we'll talk about a lot of different ways to think about that and get into kind of some of the details about not only how I approach the system, but also some ways to think about how you might adjust it within the context of your own needs, all the way until an option is available, until the day an option expires. Excuse me. Okay. With that said, really quickly, I've pulled up a chart for the S&P 500 just to kind of put things in a broad market perspective. Market's betting a little bit bullishly right now. We're seeing it push up to a brand new high. There we go. At the open here, and that is up here at the very top of my chart, which it's having problems giving actual number over here on the right because of how extended the chart is. We're pushing to a brand new all-time high. So it looks like it is breaking the resistance that was up here, probably around a little bit below 6,500. What is driving that? Why is that happening? And is that good or bad for what we're trying to do? Well, some of the recent reports I've been following show things like the latest jobs report that came out this morning was saying that the hiring was not as was a little bit more tepid than had been anticipated. So that suggests that hiring is still slowing down. That sounds like a negative thing as far as the economy is concerned. Why is the market betting on that being a positive? Well, because the market is looking for interest rates to come down, and if numbers like unemployment are increasing, available jobs are decreasing, those are things that tend to prompt things like a more accommodative interest rate policy. And so the market is really paying a lot of attention to economic data, trying to see if there are signs that things are moderating, cooling enough that rates will finally start to come down. They haven't yet. The Fed still is kind of holding serve, but we'll see if that happens. Now, these are just kind of broad conditions, of course. Does this change what we're doing with our trades? Well, not really so much. It's not that you turn a blind eye to these conditions. It is, however, a question of thinking about how sensitive the stocks that we're working with are to broader conditions. How cyclical are they to near-term fluctuations in the economy? And sometimes that does impact the decisions that we make with the trades that we're following. So we'll really, I want to kind of set the stage from the broad standpoint first, and then as we look at some of the stocks that we're following, we'll talk about we'll be able to look at what is happening to their prices and begin to put that in a broader context. Okay. So we're on the very first week of the end of the first week of September, as far as the market is concerned. The other reason I like to do this on Fridays is because there's always as options that are expiring on Fridays. And very often that means that the trades that we're looking at are coming up on that as well. And so we have opportunities to kind of look at what is happening to those and evaluate what may be the immediate result after the market closes in the next couple of days with some of those stocks. We also have an opportunity to look at some of the existing positions and compare what's happening with them that may still have a couple of weeks to expiration, and that's nice too, because we can talk about what might be appropriate in terms of responding to those. So here we are. I've pulled up my track record just to show you the trades that are on deck. A couple of put sales, including this week's put sale on Skyworks. But the only trade that I have that is up for expiration today is a covered call on Schlumberger. So I'm going to go ahead and start there. For context, I was assigned this stock at the beginning of August, so I've held it just a little bit over a month. I was assigned at $35 right here. And then last week, I was able to sell a covered call on it at 36, so a dollar above the price that I was assigned, and brought in 67 cents for this trade. If any of you want to throw out the numbers that you got if you place these same trades, please go ahead. As you know, I like to give people like to give people a little bit of recognition when your numbers beat mine a little bit. That's kind of fun. So this is a covered call that expires today. I brought in about 1.91%, a little under 2% for a 9-day trade. That's actually really, really nice. That 1.91% may not sound like a whole lot if you're not familiar with being an options seller and selling very near-term expirations. But when you think about this on an annualized basis, and this is I'm going to show you some very simplified math here to show you what the impact is of this. But let's just suppose for a moment that you bought Schlumberger at the same $35 price, and that you're able to sell a covered call that expires every 9 days. Again, this is not necessarily, in literal terms, the numbers are going to be a little bit different, but this is, I'm showing you kind of an idealized, simplified version. Barry, okay, $36 next week for 65, in at 36, so no capital gain if you get called out. Okay, well, I'll go ahead and give me one. Thanks, Barry. So my numbers are very, very simplified here, and they do make some simplified assumptions. But that's simply because I want to try to illustrate the impact of these two numbers. Now, 9 days is a little bit less. Jay, you do have to pay capital gains on the difference between 36 and 35. Yes, that is true. The premium from options is just treated as income, just similar as if you were similar as what you're getting taxed on dividends. So this is 9 days. So to simplify this, I'm going to divide 365 days by 9. So this doesn't mean I can place exactly a trade a week. It's a little bit less, right? But that means that I'm going to, if this were to happen consistently week after week, I'd be able to place 40 trades with the same amount of capital. Now, you take 1.91% and multiply that by 40, and that's what this translates to, a little over 76. Again, this is idealized. It's very simplified, so there is some variation here, but this does demonstrate a little bit of the potential power that we're tapping into by selling very near-term options on a consistent basis. When you can do this, again, I may not be able to place 40 trades here with the same capital, but I am going to be able to place a lot more than if I simply bought a stock and tried to hold it and hope that it went up. And so what this does is, when you increase the number of trades, you give yourself the opportunity to increase the compounding effect of what these premiums bring in for you. If I can do this again and again and again, multiple times throughout the course of the year, with the same amount of capital, then I'm going to be doing pretty well with that. And that's really what this is based on. Barry, most of your legit trades are through your IRA, so you're not paying taxes yet. And in those cases, when you do start paying taxes, they'll just be simple income distributions. Okay. So let's see where this stands today. And again, this is the price that I sold, was 36. So Schlumberger, SLB. Here we go. And it's opening up pretty well so far today, up a little bit above 36. So it does look like, if this holds, still an open question considering we're at the very beginning of the market, the very beginning of the session, I should say. But it does look like the last couple of days it's been holding up pretty nicely. We've got a brand new pivot low right here at 35. And it is rallying a bit, so that is nice to see. So if this holds, it does look like I'm going to get called out. That's a good result. Barry sold the same strike price. He bought it at 36 for next week. If this pattern holds and it's above 36 next week, Barry, of course, you'll also be called out. That's also not a bad result, because what we're really going for here is the income from the covered call trade. If I can bake in a little bit of capital gain on top, I like that. That's certainly an important part of the overall system when it's available. But there are a lot of cases where I just end up selling the same strike price that I bought the stock at, just because the income is there and I decide that it's good enough. This is one of the things about being a seller that you have to be willing to accept, is that number one, sometimes with put selling, you're going to be first thing you need to understand and accept is that sometimes you're going to be assigned. When you sell a put option, you are giving somebody else the right to, quote unquote, put the stock to you. That means that you're going to buy the stock at the strike price that you sold. If the stock is below that price at or before expiration, since these are American style options, they could exercise that right at any time. Now, typically that doesn't happen until the expiration date. But that's what happened with Schlumberger. That's why I bought the stock at 35. I took that assignment because the stock was below 35 on August 1st. Excuse me. When you sell a covered call, just as the put selling requires the acknowledgement and acceptance of possibly being assigned, with the covered call, the thing that you have to also be willing to accept is that you're putting a very literal cap on how much gain you can possibly see in any trade. By buying Schlumberger at 35 and by selling the covered call with a strike price at 36, I'm saying that I'm willing to let somebody take the stock from me at 36 if the stock closes above 36 today. Well, they're only going to call me out of that trade if the stock is actually above that price, and they're going to be able to take a positive gain from it. That means that right now that's not such a big deal. The stock's only a little bit above 36. So if this pattern holds, great. That's a very good result. But what if suddenly the stock picks up momentum, and let's say it closes the day at 37 or 38, or boy, what if all of a sudden it's at 45? I'm not saying any of these are likely. It doesn't really matter because I sold my covered call and I put the lid on how much gain I'm going to get right at 36. That's as far as it's going to go, no matter how much further the stock goes up. For growth investors, this might be a little bit demotivating. They might say, well, I don't want to sell a covered call for that. Well, that's fine if that's not what you want to do. But in order to accept that cap, I brought in 67 cents per contract per share. I sold one contract because I only own 100 shares of the stock. But that also means that for the $3,500 in capital that I had to put to buy the stock, I was able to bring in a little under 2% for 9 days. And still, again, when you consider the compounding impact on what this can be, might not sound like a whole lot, but 67 cents, 1.91%. This adds up when you do it again and again and again over time. This is where we're talking about picking up the low-hanging fruit. The $1 of capital gain that I'm going to have here as well just simply sweetens the pot, makes the net result a little bit sweeter. But very often I'll do exactly like Barry did, because the income is enough, and you have to be willing to accept that when you place these covered call trades. Whatever the strike price you set is, you are putting an absolute cap on how much gain you make if the stock starts to really pick up momentum and starts to accelerate. All right, sorry, Barry, you left a comment here a little bit ago. For what it's worth, I'm using your method on most of my IRA trades, even if it's not always your recommendation. Awesome. And the idea here is not necessarily that you only follow my trades. I'm trying to help people understand the power of put selling and income generation, so that you can apply these on your own as well. Just like you're saying, Barry, he says they've yielded about 20% return over the last 2 years. That's, some people say, well, but the S&P 500 has done a lot more than that. Well, maybe, yeah, and there's going to be those cases. But are you trying to chase the market, or are you trying to be a functional investor and see enough growth to meet your needs and your purposes? For me, I stopped trying to chase the market a long, long time ago. And the long-term results of my trades so far have been more than favorable enough for what I need, and that's good enough. And as we've just been talking, here we go. We're dipping down a little bit below 36. So I may still end up holding my shares if the stock is below 36. We'll see. And now we're back. Okay, Jay, some of your trades are in your HSA. Okay, awesome. All right, let's go ahead and move on. That is Schlumberger. As you can see, we'll see where this one settles for the day. Really quickly though, for Barry's benefit, let's take a look at the options for Schlumberger. We'll close out today's expirations. Here's next week. And selling the 36 call right now. So stock hasn't moved quite enough away from 36 to make trying to do something with this trade worthwhile. Looks like if you wanted to buy it back, you'd have to pay 67 cents on the ask. And Barry, I think you said that you'd got 65. Is that right? Yep, 65. So let the week pass, right? We've got a weekend coming up. That's 3 days where the market is not open, but time decay is still going to work in your favor. There may be an opportunity if the stock picks up momentum first part of next week to maybe think about think about maybe buying it back sooner and rolling the trade. If it seems like I'm holding for a while, these are stocks like, well, a lot of the food products right now, CAG, KHC, Halliburton. I start reinvesting the dividends to compound those, even though I could take the cash from the dividend payout and use it towards other things. Absolutely. And there's lots of ways that you can approach this. I just treat the dividends as just regular, just another component of the overall income generation, right? Just adds that much more to the premium that I'm bringing in, and it becomes another part of the overall account and the capital that I'm able to deploy, whether that's still with the same stock or with something else. But you can certainly, if you want to take advantage of a DRIP program that a lot of companies offer with dividends, nothing wrong with that. You're going to end up holding more shares, and that's if the stock starts to pick up momentum, that's going to benefit you more, right? So DRIPs DRIP means dividend reinvestment plan. I like them. I think they're kind of cool, and it's something to think about whether or not you want to take advantage of that. So, okay. So that is Schlumberger. We'll probably have some time to talk about some of the other stocks that maybe some of you are following. So we'll see how things go. Let's talk about next week. A couple of weeks ago, we placed a put sell on CTRA. This is Coterra Energy, an dipping a little bit back into this, into the energy side of things. Um, excuse me. Where last one that I had was on Halliburton, and that's one I'm still in at 26. But this is adding to that position a little bit, adding to my portfolio, I should say, with another stock in the same energy sector. So I sold the $23 strike price, and that expires next week. I brought in 49 cents for a $23 stock. That means that I brought in a little over 2% for the 23 days that this covers. So this covered a little bit more time than, say, my covered call on Schlumberger did. I generally am looking to try to sell a month or less. So you're going to see some variation in these numbers, but very often most commonly these trades are between 16 and 23 days. This one is 23 days in this case, so we'll see how this goes. I sold 2 contracts on this. So my total capital reserve requirement on this is $4,600. These are numbers that I am keeping purposely very conservative in terms of the size of these positions. I'm trying to limit the exposure that I have in any one trade as much as possible. Why am I doing that? Primarily, this is around risk mitigation. Diversification is certainly a part of that, because working with smaller sizes allows me to work with more stocks. But being able to work with more stocks is really more about trying to keep powder dry, at least right now for me, than it is about trying to diversify my portfolio as widely as possible. So this is really about trying to limit risk exposure first and foremost. And just to think about this on an annualized basis, 365 divided by 23 means up to about 15 trades per year with the same capital. And so 2.13% times 15 is a little under 32%. So you can see how the numbers vary a little bit depending on the time periods we're working with in terms of the compounding effect. But still, very conservative trade. 2% may not sound like a huge number, but that actually works out pretty nicely on an annualized basis. Any growth investor that could get 30% or more on just by buying a stock or by playing options, they would be happy to do it. So why do we do put selling instead of buying on the other side? It's really about probabilities. For me, I learned throughout my career as an investor, I started, of course, just like everybody else, just trying to scrap together what savings I could, and trying to buy stocks and hope they went up, and try to leverage my retirement savings in my 401k as much as I could. I realized very quickly that the probabilities of success when you're talking about just being a buyer are actually pretty low. It's actually about 25 to 30% a winning rate. That means that out of every 10 trades, you're going to be right probably no more than 3 times. That means 7 losers to 3 winners. That doesn't sound great. Here's the other part of that. If you think about that over time, now let's multiply that by 100. Now you're 30 times right, 70 times wrong, right? If you think about that in terms of what that looks like over the course of time, that also means that you're going to have extended periods where you have loss after loss after loss after loss. Now, that doesn't mean that you can't make money with these kinds of systems, but it puts a very big premium on your ability to minimize loss on those losing trades and on maximizing gains on the winning side. Minimizing loss can be made pretty straightforward when you use things like stop losses and some of those kinds of things. Maximizing the gains on the other side, on those few winners that you have, that's another nut that is kind of tough to crack, because once you have a gain, there's a real tendency and a temptation to take it as fast as you can. Well, if you're maximizing your gains, the idea is that you're letting those winners run. You're maximizing upward trends when you have an opportunity to do it. Um, the emotional impact of those losing trades makes uh, being able to let a winner run kind of a tough thing to do. Yeah, there's a lot of other stats you need to think about. Absolutely. Probabilities are not the only one, but this is the gist of one of the reasons I came around to put selling. When I started to realize what the probabilities looked like for being a buyer, I started trying to figure out if the odds of success were so bad for me as a buyer, what are some things that I could do? I started to think about the other side. What about the other side of it? The guy that is selling me the stock or selling me these calls and these put options. And that started the investigation that led me to where I am today. And it's actually if the probabilities of success are so bad for the buyers, it is exactly the opposite for the sellers. Now, if you're taking an active management approach, you're rolling trades, you're buying them back the way that we'll talk about here in a minute, then your probabilities of success are probably 75 to 80%, which is awesome. Using it the way that I do, which is to kind of let the result be the result. I hold the option all the way through expiration, and if I'm assigned, I'm assigned. If I get called out, I get called out. That's given me a success rate in excess of 95%. And I'm not saying that to brag. It's just the difference between probabilities. When you can flip the script like that, these numbers, 1.91%, 2.13%, 2.34%, repeated again and again and again over time, that's how these really start to add up. Okay. And as Gibbs says, that's just one more piece of the puzzle, right? Things like position sizing, how much of your account you're going to allocate to a single trade, how many possible positions you want to be in at any given time. All of these are a part of the equation that you have to think about for yourself. Okay, that's it. Soapbox done. CTRA. Let's go back here and take a look at it. Okay, I sold the $23 strike, and the stock has been pulling back a little bit over the last few days. It had hit a high at about, looks like 24.75 roughly. That's bad handwriting. And it's been tracing back a little bit, but it's got good support. Oops. It's got good support from the 20-day moving average right now, this green line, which is right around 24. And so far, it looks like it's holding that level. So let's take a look at that one and see where that sits. All right. Yep. So we're out for next week on this one. This is the $23 strike. Now remember, on this one, I brought in, what is it, 49 cents? Yep. 49 cents. The asking price on this 7 days to expiration is 10 cents. So this means when I sold my option, I brought in 49 cents. If I wanted to quote unquote roll this trade, I could buy it back right now, buy it at close for 10 cents. That's not even monkeying around with trying to set the price that I want. It's just saying the asking price is 10 cents and that's good enough. And I would still hang on to 39 cents of the premium that I brought in. And I would close out the potential obligation. There's still 7 days to expiration on this, which means there's a chance that I could still be assigned at 23. Now, that's okay with me. I never sell a put option unless I'm willing to buy the stock at that price. That's why I hold my contracts through to expiration. But when you have a positive number, when you're looking at a positive number like this does change. It doesn't automatically change the decision that you're going to make, but it can impact. It does give you some other options to think about. And when I say options, I'm not necessarily talking about contracts here. Some other choices to think about, right? 39 cents. I'm sure if I were to buy this back today, I would shorten the time period of the trade from 23 days to 16. I give back a little bit of premium for that, but I would also get the capital that I put in reserve back. The $4,300 that I have in reserve right now cannot be used for any other trades. So if I did buy this back, that money would be available in my account right now, and then I could redeploy it, whether it's with CTRA still or something else. That's the next question. But let's just think about let's think about the decision on this one. And Barry beat me. Sorry. Barry beat me on this one. Bringing in 52 cents versus my 49. But here's 39 cents. Let's see. Let's do 365 divide by 16. Now you're talking about possibly 22 trades per year, right? So 0.39 divided by the same $23 strike price is 1.69%. So when I multiply that by 22, now we're above 37%. Okay, so the trade that I placed, the one that I am holding, if I'm able to repeat that result every 23 days, I'm doing a little under 32%. That's okay. That's actually a great result. I love it. But here's the impact of being a little more active, of increasing your trading frequency a little bit. You can accelerate that compounding effect, possibly by up to about 6% higher than what I am doing. And this is, again, this is an idealized number, but it's not actually all that far off from reality. A lot of members of our of the Rebel Income community that many of us know are very active about doing this. They will buy back anytime there's an opportunity to buy back the contract and realize a majority of the and still hang on to a majority of the premium you brought in. They'll go ahead and do that because the capital comes back to them immediately. They're able to redeploy it more quickly, whether it's with the same stock or with something else. And so they'll be able to increase. They'll be able to place more trades and increase the compounding effect. And Barry, if nothing is out there to trade, you can sit on your cash and get the 0.01% interest through Schwab. And if there is nothing else out there, that's one of the other reasons that I'm okay with letting that sit for the additional 7 days, right? That's fine too. Whatever your decision-making process is. None of these are bad choices. But let's say that I did buy this back. And again, there are people in our group that would be screaming at me right now. Why aren't you doing this right now? Because this actually looks pretty nice. Now with the stock up here closer to 24, a little above 24 right now. This is interesting. Going out one additional week at 24, I can sell the 40. I can sell the 24 for 40 cents, which is going to be right around 1.5%, maybe a little bit above it. 0.4 divided by 24. Yeah, 1.66% for 2 weeks, for 14 days. Not a recommendation to buy or sell as usual. Keep my coward's door swinging here. This is just for educational and entertainment purposes only. But this is a really, really good example of where you often have an opportunity to leverage put selling with a little bit more active management approach. Okay, that is CTRA. And Barry is sitting in a little bit better position than I am. So if you're going to think about rolling that trade, you'll probably do even a little bit better than I did. So that's great. The other two put sales are on Comcast and on Skyworks. Skyworks is the put sale that I placed this week. Comcast was last week. We'll check in on these here with Comcast. I sold the 33.50 strike price. And just in the interest of transparency, this is a stock that I also hold shares in at a much higher strike price. So this is an opportunity for me to try to average my cost down a little bit on Comcast. So CMCSA. I've held this one for a little while, and it's been following this pretty extended downward trend. So right now it's around 34. Just kind of seeing the last couple of weeks, just a little gradual increase in price after a pretty impressive rally off of this 52-week low at the early part of August. So it's just kind of tracing up very, very slowly. I sold the 33.50, so it's a little bit above that, which is nice. We're still, again, a couple of weeks to expiration on this one. So I'll be surprised if there's a big difference between what I sold the option for versus what I could buy it back at. But let's take a look. All right. Well, this is interesting. Okay, 33.50, brought in 65 cents on this one. And if I bought it back, I'd have to pay about 38 cents right now. Plenty of open interest, no activity so far on this one. Reasonable distance between bid and ask. So this is a little under 50% of the total premium I brought in. Most of the people that I know who are active rollers are usually not going to be thinking about buying these back unless and until they have an opportunity to keep at least half of the premium that they brought in. So on 65 cents, that means possibly putting in a buy to close with a limit order at around 32 cents. This is very near to that, but obviously there haven't been any bites here to try to vary the amount enough here. to do that. So we'll see how this goes. This is very near to that range. Even if that doesn't happen, today, that's okay. That's not a terrible thing because again, we have the weekend. And here, Barry, you got another one because his trade expires today. So a couple of weeks before mine, and he brought in 58 cents for the $32 strike price, which is awesome. That's a great result. I love that. So if there's an opportunity to hang on to about 50% of the premium you brought in, that could be a reason to think about whether or not you want to roll the trade or not. If you don't, that's okay. Let's take a look at Barry's contract. I'm going to need to expand this a little bit. There we go. Here's the $32 strike. We can pretty much look at how the premiums in the asking prices here increase, despite the fact there's nothing on the bid. That's interesting. That just means there's no trades that are being placed, and the bookmakers aren't adjusting prices. Okay, 24 days. So you placed this one a little before I did, which is fine. Just means you're a little bit ahead of the game. Right? Maybe I put it on your radar, but you decided to use it before I did. So 197 contracts in open interest at 32. And this expires today. So you could possibly put in a buy to close order, considering the distance from the current stock's current price. You could think about putting in a buy to close for a nickel, right? And see if that gets taken. If so, then what would be the advantage of doing that as opposed to letting the option expire worthless, which it certainly should do today, right? Why would you want to do that? Well, at this point, it's a question of trade settlement. If you buy an option back before the market closes, the money that you put in to reserve that trade becomes available immediately. As soon as the transaction is completed, boom, you'll have the capital available to trade again. Whether or not you use it today or maybe next week, that's a different kind of question. If you do what I do, which is to let the option simply expire, then you have to go through normal trade settlement, which means that the capital doesn't come back for 1, possibly 2 trading days, depending on the broker that you're working with. For me, that usually means that the same capital isn't available to trade until usually the Tuesday or Wednesday after the option has expired. That's okay. That's part of the reason that I built my trading system the way that I do. The reason I highlight a new trade on Tuesday and then I place it on Wednesday is that's built in part built to try to accommodate trade settlement. But by closing the trade earlier, if you buy it back before the market closes, you don't have to worry about the same constraints. You have the money back sooner, and as we've demonstrated, even the difference of just a couple of days can be material in terms of your ability to increase trading frequency and therefore increase the compounding effect, which is really one of the things we're trying to really take advantage. That is one of the advantages put sellers have, is that compounding effect. So anytime you have an opportunity to do that, you're leveraging the advantage you have over the rest of the market. Okay. So Barry, there you go. Not a right. There's not really a right or wrong answer to that. It just becomes. It really boils down to what your preference is. All right. So that's Comcast. Let's check in with Skyworks. Got just a few minutes left, and if any of you have some other stocks that you're interested in taking a look at, feel free to throw them into the chat, and we'll get around to those as well. So, Barry, you're just going to let it expire, and that's fine. If you don't have anything else to do with the capital, that's okay too. That's, like I said, my method is to let the option expire and go from there. So, all right, with Skyworks then, on Wednesday, I sold the 72.50 strike price, bringing in $1.70 per share for a 16-day trade. This is a little bit shorter than what I highlighted when I sent out the trade alert. It was for a 23-day trade, if I remember right. No, I take it back. No, this was still 16-day trade. Did have to adjust the strike price though, as the stock was picking up momentum the next day. Was able to bring in about 2.34% for the trade, however, which was a pretty nice result for 16 days. Let's take a look at what Skyworks is doing today. There we go. 72.50 is the strike price that I sold. So that's right around here at the bottom, right here where we had a nice little pivot low. Stock is picking up some positive momentum and now sitting at around 75.53. So that's good. That's a couple of dollars away from the strike price that I sold. So sometimes stocks move fast enough to give you some choices to think about very, very quickly. This is also a stock that doesn't offer weekly options. And remember, I brought in $1.70. That makes these numbers, here's my contract, that makes these numbers very interesting. If I bought this back right now, I'd be looking at 90 cents on the ask. That's a little under 50%. But considering there's a 15-cent distance between bid and ask, there's enough open interest, not a ton of volume on this. Again, if your method is to try to leverage the compounding effect by being a more active trade manager, you could think about possibly setting up a buy to close. This is not my recommendation, mind you, at 85 cents. That would give you exactly 50% of the premium that you brought in, or that I brought in, I should say, 2 days ago. Okay, that might not sound like a whole lot, but again, let's think about this is a stock that has moved. It's about $2 away, actually a little bit more than that, right? It's $3 away from the strike price that I sold 2 days later. That's enough momentum and enough distance to make thinking about rolling interesting. And when you put that in this broader context, 365 divided by 2, 182 trades. Again, this is very, very unlikely, but this is 0.85 divided by 7250 times 182. 213% if you're able to do this every 2 days. Again, you're not going to be able to do this every 2 days, but this is, you saw the variability of the expiration dates that I work with on the contracts that I sell. right? Part of the reason for the variability is to take advantage of very short-term opportunities when you have them, because sometimes you get opportunities to do this in 2 days. And when you can do that and then redeploy your capital in something else, whether it's with the same stock or with a different stock, sometimes there's a lot of traders that are going to go ahead and do that. That are going to decide that that is more than worth it. And if you are in that camp, if that is something that makes sense to you, then by all means do it. You're going to be able to see some accelerated returns compared to what I generate with my trades by doing so. The caveat to being a more active trader is that you have to understand that you understand the need to be nimble. And what I mean by that, my method is to set the trade, let it expire. That doesn't mean that I don't pay attention to the stocks that I'm working with every day, but it does mean that I'm not trying to actively, um, I'm not looking to actively manage the results. If you are in the camp of being an active trade manager and the stock moves against you, remember I said that when I sell a 72.50 strike price for Skyworks, I am actively saying I'm willing to buy the stock at that price. For most rollers, the perspective is a little bit different. It isn't necessarily saying that you aren't willing to buy the stock at that price. It usually means that the preference is to get out of the trade before expiration to as much as possible avoid an assignment. So you're really trying to leverage some of these short-term moves that stocks make, like what Skyworks is doing now. It's a little bit more leaning on some of the swing and momentum trading methodologies that a lot of people will use on the long side. That means that if the stock is moving against you quickly, you need to be ready to be just as nimble and buy the option back quickly to minimize the loss. So where I'll go ahead and let that trade extend, I'll take the assignment. Most of the active managers will be out of that trade not only days, but usually a week or more before expiration, because it's moved against them enough to make them decide I need to move on and go find something else. And that is 1,000,000% also okay. But it is a difference of trading style that you have to be willing to accept and account for if that's the way that you want to trade. Okay, Barry, the time, we've got just a couple of minutes left here. Bought Ally at 4106. Let's see. Oops, I guess I need to type it right. Ally Financial. There we go. 4106, and immediately sold a $42 stock, 42 call for 208, expiring 11/21. So there's pretty long term covered call, right? Because that's you're talking about a little bit more than 3 months in time. So Barry's taking a different approach, adding a little bit different wrinkle here by selling more time, also increasing the likelihood that he's going to get called out at 42 by selling more time. When you add more time to an option contract, you're giving the stock more time to move in the direction that you want. Therefore, in most cases, increasing the likelihood that that'll happen. So his strike price is at 42. What is the flip side? Well, what if Ally is at 84 on the week before Thanksgiving? Well, too bad. He would have been called out long before at 42. So, but that's okay. He says it has a decent dividend yield if you're still holding it through the next dividend declaration. So And here 30 cents. Yeah, you're talking about $1.20 on a $41 purchase price. Yeah, that's okay. That's more than okay. So it's a good trade. Just a little bit, again, a different wrinkle. But what I like about this is that instead of simply buying the stock and thinking about, oh, I hope it ends up going up to 85. I'm just throwing that number out here, obviously. Um, what can I do to put the stock to work for me right now? Are there things that are available? Where is the low hanging fruit right now? And what does that look like? And is that good enough for me to want to take advantage of it? So I love that you're doing that, and that's exactly the whole point of what we're trying to do with these Rebel income trades. Is identify for any stock that we're looking at that you're interested in. Look at what is available and what is the rest of the market not paying attention to. What are they missing? Those pennies, dimes, quarters, whatever it is, these premiums that we're bringing in, nobody else is really paying a ton of attention to. But when you do this again and again and again, you're talking about real returns, and this is the reason that I call it the low hanging fruit. So looked at the premiums prior to making the trade. Of course, that's awesome. That's exactly 100% the point. So thank you, Barry. I appreciate you sharing that. We are a little bit over time, so I'm going to go ahead and call it, but I really appreciate everybody who's here and for your participation. Thank you so much. And hope you have a wonderful weekend as always. If there are questions or anything comes up between today and next Friday, please do reach out to me. Send me an email, rebelincomesystem@gmail.com, or you can also reach out to me on Substack or on Discord if you're on there as well. Thanks again. Everybody have a great weekend, and we'll talk again next time.